All right, and now I am going to introduce our last set of presenters. And so this will be a pitch for acquiring El Paso Pipeline. Adrian Dela Cruz is on the team. He is a senior from Topeka, Kansas. Adrian is graduating in August of this year with his BBA with a finance emphasis. After graduation, Adrian plans to continue his employment with the U.S. Postal Service, but only until an opportunity in the financial planning industry arises. He currently lives and works in Lawrence. Zachary Riggins is a senior majoring in finance, graduating in May 2013. Zach is a former captain of the Washburn men's basketball team. That's 3 varsity athletes in this year's class. Zach says, APM have sculpted me into a more diligent and enthusiastic student of business. My future plans are taking shape. I am currently looking for a challenging opportunity in the finance sector. And I can tell you that Zach had a very busy competition schedule during the first half of our semester, and you would never know it. Every Monday night, he showed up all business, ready to talk finance and leave basketball on the court. And so when he talks about challenging opportunities, he knows what he's talking about. And Zhan Zhang earned a bachelor degree of science in accounting with honors from the Central University of Finance and Economics in Beijing, China. Now she is a second-year graduate student majoring in finance and participating in Washburn's exchange program. Zhan has an article published in the Gansu Finance Journal in May 2009 and has had a summer internship with China Galaxy Securities in Beijing in 2011. A true international citizen, if there ever was one. And so I will welcome the El Paso Pipeline team to step forward with their stock pitch.
All right, thank you, Dr. Wiegand. As he said, I'm Adrian Dela Cruz, this is Zach, Zhan, and Bree was also one of our cohorts on this analysis. As we discussed earlier, we are currently underweight in the energy sector, and as I'm going to show you here, this is our analysis of the 21 Conference Board economic indicators. The lagging and coincident indicators show the large growth that we had last year, and also the leading indicators show that we will maybe be looking for some kind of economic slowdown in the next coming 6 to 9 months, which is why we think maybe energy will be a good spot to position ourselves defensively against some kind of slowdown. Our beta is 0.24, which is significantly lower than our portfolio beta of 0.84 or 0.81 when adjusted. And our dividend yield is also far superior to almost every other dividend yield. There's only 3 stocks that have a dividend yield that is higher than EPB's. El Paso Pipeline Partners, they are engaged in transportation, storage, and distribution of natural gas in the Midwest and also in the southeastern U.S. Their natural gas pipeline, 13,000 miles of pipeline, approximately. They have a 100 billion cubic foot aggregate storage capacity, which 6,000 cubic feet is about enough to heat a house for a week, and 1 billion cubic feet, I think, will heat 10,000 for a year. And they also have connections to many large shale plays through acquisitions, which I will show you. This is a map of lower 48 state shale plays. As you can see, there are lots, and especially focused here in the Midwest, or I guess it's further west, you could say, and then in the southeast, right in this area. And here, you can see where their pipelines are positioned, right in the major shale plays here in the west, and also in the southeast. You can also see they're providing pipeline endings in places where there are no shale plays, such as the top of Florida and Georgia down in the southeast. Kinder Morgan has recently purchased EPB. They purchased El Paso Corporation, which through a list of subsidiaries owns El Paso Pipeline Partners, and they have convened to make one big, huge midstream energy company. And midstream energy companies are mainly concerned with advertisement, marketing. They're not concerned with producing or exploring energy plays. Recently, UPS has announced that they will be converting some of their fleet to liquid natural gas which will allow them to run longer drives on less fuel, and perhaps even cheaper with the current price of natural gas. Like I said, UPS plans on expanding its fleet from, I think, 112 this year to 800 by 2016. And there also is a growing network of filling stations around the U.S. Mostly are concerned with compressed natural gas, and a lot in California. 2/3, I think, of the concentration in California is liquid natural gas. This is the SWOT. They're strongly aligned with parent companies. What I mean is their capabilities are strongly aligned with Kinder Morgan. Kinder Morgan is a huge company, a huge energy company, and their assets are correctly aligned to provide a future bonus for El Paso Pipeline. There is a substantial demand for natural gas, and they are, as I showed you, well connected to shale plays in the south and west. And over 90% of their revenue is from capacity reservation charges. And capacity reservation charges are, you reserve part of the pipeline, you reserve a certain amount of volume, I guess you could say, a certain amount of volume, and you pay for it no matter what, even if you don't use it. So they're a little bit more protected from demand. If demand sinks, they still make revenue from capacity reservation charges as opposed to the lesser usage charges. Weaknesses, high debt. They've been making a lot of acquisitions recently. They have a sizable third-party dependence in the upstream and downstream companies that are available. And the revenues are highly concentrated, of course, in the pipeline and storage segment. The opportunities, growth in emerging markets in the southeast and in the west, growth through acquisition, like I've already shown, large investments in pipelines serving major shale plays, I've also shown, and then continued investment in the expansion of pipelines. And what I kind of mean by that is if we do see a demand increase in natural gas, we will likely see a larger investment in the expansion of pipelines. Threats, loss of market share due to intensity of competition. They could be replaced by another competitor. Volatility in natural gas prices, though it's not as much of a threat as I discussed with the capacity reservation charges. Supply and demand won't affect the company as much. Could be an increased regulatory environment that have to do with fracking, as well as major environmental risks, which fracking could be a huge environmental risk if certain things, if it doesn't pan out to be as well or as environmentally friendly as we currently hope that it is. Supplier power, importers' five forces. There are a moderate number of suppliers in upstream and downstream companies. The suppliers are large. They're mainly focused on, they're at one shale. They're ready to go. There's for that reason, we've decided it's a neutral supplier power. Buyer power, there are a lot of buyers. People are always buying natural gas. We use it to heat our homes, heat our stoves. There's a heterogeneous market, and the contractual capacity reservation fees, I think, are one of the main reasons I rated this buyer power so low. Competitive rivalry, numerous competitors throughout, obviously, the states. There are lots of exchange agreements and government mandates that could replace EPB. There could be other pipelines serving the same market. However, it's not as likely because pipelines are expensive to make. If there's already a pipeline in place, you might not want to take a big risk to go on and make a new pipeline where someone's already serving a market. And threat of new entrants, moving away from natural gas-based energy is probably in the distant future. We use it for tons of stuff. UPS is expanding its line of trucks specifically to use liquid natural gas. So I think that bodes well for new entrants. It's capital-intensive industry. Pipelines are expensive. I don't know anyone that has one. And there's an increased amount of knowledge necessary to run it, to transfer. And I think with that, we will go on to the historical performance with John.
Here is the historical performance analysis. First, let's say the 3-year CAGR. As we can see that the total revenue and the EBIT both are growing by over 10%, and the free cash flow CAGR has a vigorously 3-year data that has approximately 65% with its NOPAT at 16% and the total invested capital at 3%. And also there is a positive signal here that both EVA and MVA have a 3 CAGR over 23%. Next is the margins and the yields. As we can see that EPP has the growing operating margins and the free cash flow margins at a very fast speed. And also the earning yields and the dividend yields both growing by over 5%. The next is the per share metrics. EPP has the dividends growing increasingly year by year, and with the earning per share experience slightly volatility, and the NOPAT and the free cash flow here are reported recently at over $3, which is a strong sign of its intrinsic value creation. Here is the return on equity. As we can see that the EPP has increased its ROE year over year. And this is the comparison with its main competitor, MMP, which is the Magellan Midstream Pipeline Partners. And although MMP keeps leading the EPP from 2009 to 2011, the EPP finally surpassed MMP in the most recent year. And ROE is also a strong factor in our fundamental process. Here is the return on invested capital. This is another comparison between EPP and its competitor MMP. We can see that although EPP lagged the MMP over the past 4 years, well, it can still maintain and generate its ROIC over slightly 10%, and which is demonstrating the capital-intensive nature of this industry, and also the strong and severe competitors of the industry. Here is the NOPAT per share. As we can see here, EPP has consistently exceeding MMP in its NOPAT per share over the past 5 years, and a higher NOPAT provides a substantial support for its stock price. Moving on to the invested capital per share. In addition to a larger NOPAT, EPP also has larger total capital per share than its competitor MMP over the two drops in the 2008 and 2009, but it recovered very soon and keeps exceeding the MMP over the past 3 years. And free cash flow is also a strong sign for of the support of its stock price. Now let's looking at the EVA. EPB has consistently leading in its EVA over the past 5 years, and but it is also important to notice that over the recent 2 years, the spread between the two has shrunk. And here is the MVA. As you can see here, the MMP has leading the MVA over the past 3 years. Well, with the higher EVA, it's even provide stronger evidence here that EPB is due for a catch up in its market value. So it provides us a sign of optimal buying time. And the last part of the historical analysis is the 1-year stock performance. As we can see here, in the late 2012, the EPB still lagged the Standard & Poor's 500 index. But in the January 2013, it starts break up out over the Standard & Poor's 500 index, and it has maintained a higher returns than the Standard & Poor's 500 index. And now I'm head over to Zach. He is going to talking about the forecasts and the assumptions.
Where we try to model a slight margin of safety into the pro forma metrics and per share intrinsic value. First, we'll take a look at the balance sheet forecast. And our balance sheet assumptions are consistent with the 5-year averages, with just slight changes that we've made in order to stay conservative and more recent. Next, moving on to the income statement forecast. We first want to look at revenue growth. As Zahn has mentioned earlier, they have increased revenue almost every year except for last year in 2012. But we've forecasted a 7.7% increase for 2013, 10.5% in 2014, and just have tapered that down to a long-term growth of 2%. We got that help. We had help from this thanks to the tools that APM provides us with. Capital IQ has predicted a 5.65% increase in 2013 and nearly a 12% in 2014, while Yahoo Finance predicted an 8% increase in 2013 and also 11% increase in 2014. We also expanded gross operating and net margin, just getting rid of the 08 and 09 recession years where the numbers were just a little bit lower, just an effort to stay more relevant and more reliable for averages for the margins of the future. Common shares growth. We don't think they'll be able to withstand the average of that. Actually, EPB was only planning on increasing their common shares growth marginally the next few years, and into a long-term growth of 1.5%. Dividend growth, we see them in the past 4 years. They've actually had an average of about 18% in growth in dividends, which just looked great for us. As Zahn had mentioned, a 5.3 dividend yield is what they have posted, and we foresee a 13%, a very conservative approach on this dividend, with a 13% increase in 2013. And we have tapered that down to a 2% long-term growth, just matching our revenue growth as well. Taking a look at our WACC, we have bumped up our 5-year beta from 0.24 to 0.55, just getting it closer to the market average of 1. Also came up with a cost of equity of 5.9 and giving us a very low WACC of 5.1%. Moving on to the free cash flow, discounted free cash flow valuation of the intrinsic value. You see that EVA, MVA, free cash flows, and NOPAT are all expected to increase, just feeding right into the intrinsic value of the firm. Yikes. We see that that 2012 we have it at $83 compared to the current price, or last year's ending price of $42. Looking at the dividend discount model, as I've mentioned before, they have increased their dividends every year, and bringing over that from the income statement, we have dropped in the dividend growth rates of 13%, 7%, and just tapered that down to 2%. As you can see, that EPB is extremely undervalued by dividends alone, which is great for our investment process for here in the student investment portfolio, that we're tax-free exempt on dividends. So this is great for our portfolio. Here's just another look at the current price versus the intrinsic value. And as you can see that in every metric, EPB is seriously undervalued in every metric that is here. Just to sum it up, I'll read you our investment thesis, and that comes up with our buy analysis. An increasing demand for natural gas implies that more pipeline will be needed to construct in order to keep capacity on pace with demand. In the face of an economic downturn, it is prudent to increase our portfolio exposure to the energy sector. Along with a very low beta, EPB will position the fund a bit more defensively in the event of a future slowdown in the economy. As shown by high and increasing profit margins, EPB has a history of efficiency gains and is continuing that trend currently. Free cash flow margin approaching 40% is a major positive in this investment process. EPB's commitment to increasing dividends is just another positive factor for the student investment fund, which I mentioned is tax-free. EPB has consistently grown dividends since they first became public in 2007 and has a dividend yield of over 5%. EPB is significantly undervalued based on the dividend discount model. And as a main competitor, Magellan Midstream Partners, MMP, has recently had a large upward jump on its price. EPB has just recently started to have a significant upward movement, and actually plateauing of late, and we are predicting the same strong upward price movement will occur in the stock for the next 3 to 5 years. Just want to thank you for everything, and if you have any questions, we'd love to hear them.
Questions on this thesis?
Brandon Hawley, U.S. Bank. First of all, great job, guys. My question is specifically in the financial analysis and valuation section, page 1. 2012 to 2013 expected total revenue growth of 116 million, or 7.6%. You have net PP&E growing 471 million, or 7.9%, and also equity growing by 21%. Kind of wondering, and also debt. You also have debt decreasing. Kind of wondering, with a revenue increase of only 116 million, with actually debt decreasing, how are you planning to fund an increase in net PP&E?
Please do.
Okay. Our model takes each and every line item of both the balance sheet and income statement by itself, and therefore, although we see a net PP&E, I believe it was an increase in net PP&E, and we also forecasted a relatively low decrease in debt and increase in equity. Again, our model takes each balance sheet line item and each income statement line item solely on its own, and therefore we looked at the past 3 to 5 years and tried to look at some trends to forecast any growth in net PP&E, and then looked solely at debt, looking at the past 5-year trend, and then forecasted based off that past 5-year trend. Again, as this is a percent of sales, and then for equity, we looked at that in unison, and then looked at, I believe it was the past 3 years, because we saw, I want to say we saw some increases in equity. And so therefore, what I'm trying to say is that we looked at each part in unison. And so although we do know a 7.7 or 7% increase in sales, Net PP&E will be funded by both debt and equity, but for this purpose, we looked at them on a standalone basis.
Thank you. Other questions? Yes.
Michael Roscoe from U.S. Bank. So, this one's a little harder for me in the sense that the company is much more leveraged, and obviously it's an energy, natural gas play. But one of the things that I've noticed is a lot of the infrastructure they've built out, they've done with debt, so they've leveraged their balance sheet. Do you know what kind of debt this company issues, and is it fixed rate debt or is it floating rate debt? And is this somebody that in the face of decreased energy prices or a rising interest rate environment could see substantial drops in their free cash flow because of that? And how do you get comfortable with that?
Well, I haven't researched what kind of debt actually it is. I know that for the way they structure their pipelines and with the increased demand actually for natural gas. Actually, can you repeat that last part of the question?
Well, they've got a lot of, their debt to capitalization. I just did it in my head. It's around 60%. So that's a high number. And so assuming that liquid natural gas prices stay where they are, then cash flows would in theory stay where they are, because I guess this is a high fixed cost operation. And so to the extent that revenues are at an elevated level, then you're going to do pretty well. But in the face of decreasing revenues, you've got a lot of debt on this balance sheet. There's a lot of cash flow today that could get impacted significantly if you have floating rate debt as opposed to fixed rate debt, or if you see a drop in revenue. So I was just trying to get a sense of how their capital structure was crafted, and whether the company's exposed to floating rate debt.
Thank you for that question. That's a very good question, and I wish we would have looked more deeply into that, because we actually did not look at their debt breakdown based on whether it was fixed rate or floating rate. However, obviously that would be of great importance if the Fed began to raise the interest rates. What we do know, though, is that debt has financed the majority of this pipeline infrastructure, and it has grown over the past couple of years. But more importantly, what we saw positive in this was that they were acquired, or their general partnership interest was acquired by Kinder Morgan. And therefore, we felt secure in the fact that they have a strong parent company and that their core competencies are aligned with each other. And so we feel that even though they are highly leveraged right now, their strong parent company will always be there for them as well. But again, to the floating rate versus the fixed rate, that's a great question, and I wish we would have looked more into that.
Thank you.
And I have something to add. I noticed that in 2008 and 2009, it has a large increase in the long-term investment, capital investment. Well, after the recession, it changed. I think it changed the strategy of the investment. The long-term capital investment just decreased sharply, and they decreased their net PPE. That's why they have such high growth of the free cash flow. Yeah. So I think, yeah, they have the floating strategy.
Other questions?
It's Heather Gilsinger again. I'd like to compliment everybody tonight. I think everybody's done a wonderful job. I just quickly wanted to say that I coached Bree for 2 years on the mock trial team, so this is an especially special night. I badgered her into taking this class, and I'm glad that she did, as well as everyone else. With you guys talking about how undervalued this company is, I'm kind of curious, what exactly do you think is going to trigger the market into believing in this company and the value? Do you see cars maybe converting to natural gas, or do you think it's going to stay more with the industrials and trucking companies and train companies? So I'm just curious, what do you think is going to really propel the stock forward?
Well, the idea is that obviously they're like I was saying, UPS has changed its fleet. Cummins has put out large engines, all for industrial use. I'm not sure as to whether they're going to specifically move into cars, and producing, car engines, so that would probably take a little bit more manufacturing. It'd take work with other companies, but at least I think a possible catalyst could be people realizing that liquid natural gas and compressed natural gas, especially with the stations popping up nationwide, that could be a real catalyst to providing some real movement, people realizing, oh, this stock may actually have some future value if there's a lasting,
So, if Heather brought Bree into this class, and since she's scheduled to remain employed in this region after law school, I may have to put her in charge of the recruitment committee for APM. Additional questions? Well, let's thank our presenters.